To everybody. I'm Fred Bergston, the founding director of the Peterson Institute for International Economics, and it's a great pleasure to welcome our close friends and colleagues from the CF40 in China to the Institute here today. As I'm sure all of you know, the CF40, the China Finance 40 Forum, is a group of top financial economists in China. It's one of the leading think tanks in China. We here at the Peterson Institute have worked closely with them for a number of years. We have joint conferences with them every year on our annual visits to China. We're hosting them here now, I think, for the fifth or sixth time for an event here in the United States. And it's a great pleasure to do so once again. Our program today will have two parts. The first will be a panel discussing financial liberalization, the financial sector in China, and its implications for China's development and economic outlook. In the course of that, our CF40 colleagues will be releasing their third annual, I think, Jingshan report, which is a comprehensive analysis by this team of top Chinese economists on the Chinese financial sector. And they'll be presenting that in our first panel. Our second panel will turn to the issue of the day, the current trade conflict between our two countries, and how best to manage that, how perhaps that can be brought to a more satisfactory outcome, as now looks perhaps promising, at least in a partial sense. Before starting the program, I want to turn to my Chinese counterpart, Dr. Wang Haiming. Haiming is the Secretary General of the CF40. He's Executive President of the Shanghai Finance Institute and Northern Finance Institute. He's Executive Deputy Director of the Institute of Digital Finance at Peking University. He's Chairman of the Silk Road Planning and Research Center. He's written a number of books on various economic and financial topics in China. He's worked closely with us in this cooperative venture between CF40 and the Institute, and it's a pleasure to welcome Haiming back to our platform here in Washington. Haiming.
Thank you, Fred, for your introduction. Actually, CF40's cooperation with the PIIE started 8 years ago with you. We won't be here today without you and Adam. We are glad to be back in your nice conference room to continue our discussion. Ladies and gentlemen, this is our CF40 PIIE China Economic Forum. This is the fifth time. For those of you not familiar with us, CF40 is a leading independent think tank and a platform for policy discussion. We work with PIIE on the most important bilateral issues. We hold at least 2 forums each year in Beijing and DC. The Jingshan report witnessed our cooperation with PIIE in the past 2 years. We have delivered 2 reports here at PIIE on China's financial opening and financial reform. Today, Professor Huang Yiping, CF40 Academic Committee Chairman, will deliver the 3rd report on financial innovation. At Fred said, we'll talk about China-US trade conflicts today. I believe CF40 and PIIE will contribute to dealing with the challenges. I look forward to hearing your views. I wish today's conference a great success. Thank you.
So, Haiming, thank you. Now we will immediately turn to the first panel, which is the presentation, as I said, of the new Jingshan report by our friends from the CF40. The presentation is going to be made by Huang Yiping. He is the Jin Guang Chair, Professor of Economics, and Deputy Dean of the National School of Development at Peking University. He was a member of the IMF's External Advisory Group on Surveillance last year. He was a member of the Monetary Policy Committee of the People's Bank of China for 3 years. He's worked at the Counselor's Office of the State Council. He is chairman of the Academic Committee of the CF40 and editor of the China Economic Journal. He worked for a number of years as chief Asian economist at Citigroup, taught at Columbia University in New York, has a very distinguished career in both the academic and official worlds in China. He has been the chairman of the group that has put together this very impressive report on China's financial system, and it's a great pleasure to look to him to present the report to us today. Yiping.
Thank you, Fred. I'm very happy to be here again. I'd like to share with you some of our findings in the third Jingsan report. This is my third report in a row, and this will be my final report. CF40 will continue with the report series, but I will step down. I think in Chinese, there is a common popular saying, whatever you do, you should not repeat more than 3 times. So I've done 3 times, and that's it for me. So we started the program in 2017, and this is the third. In the past 3 years, we focused on 3 key themes. The first year was on financial opening, and I remember I also released it here in this room. And the second year focused on financial reform, and this year the report focused on financial innovation. The central question really is that what kind of financial innovations we might need to support or sustain China's strong economic development or high-quality economic development. At the very beginning of the year, we assembled a team of researchers to work on various aspects of this subject, and including, I'm not going to detail the names, but this is, I can assure you, a very distinguished academics, former regulators, and financial industry practitioners, some still are current policymakers within the government. The starting point is that the Chinese economy is entering a new phase of development. And we probably will see more changes over the next 30 years. We just celebrated the 70th anniversary of the People's Republic of China. The government had this so-called centennial goal of when China celebrates its 100th anniversary in 2049, it has the ambition to turn China into a modern, democratic, modernized, strong economy. There are a number of lists. But when we look at this task, obviously China did well last 40 years, if not last 70 years. But looks like it could be more challenging going forward. Whatever we did well in the past might not be able to repeat going forward. So we list some of the new challenges we may have to cope with. Number one, the rising income level, which really means now the low-cost advantage has been lost. So we need new ways of developing the economy going forward. Number two, we enjoyed the so-called demographic dividends in the past, which really means the dependence ratio was declining for quite a while during much of the reform period. And that's being reversed. According to our own calculation, the dependence ratio could rise from 1/3 around 2010 to 2/3 by the time when China would celebrate its 100th centenary. That would be a big challenge. And number three, Well, we are in the middle of a range of trade wars globally. The anti-globalization activities might mean it's no longer possible for China to rely on external market, technology, capital to drive Chinese growth going forward. So whatever reason, these would mean the Chinese development going forward, the next 30 years will be very different from the last 40 years. And so the government now want to achieve the so-called high-quality economic development. There's no accurate or concise definition of so-called high-quality economic development, but the general understanding is it means high productivity and high returns in the production process. This chart is about the TFP growth of the Chinese economy drawn from our last year's report. In fact, a group of officials from PBOC put together these numbers and showing after the global financial crisis, our TFP was not really performing well. And that was, in my own view, was the key reason why the government now is focusing on so-called supply-side structural reform. We can't just rely on demand-side counter-cyclical measures, macro monetary policy, fiscal policy. We need to push ahead with the structural reforms. One of the key complaints, the reason why now we're focusing on financial innovation this year is because now there are lots of complaints about the finance no longer support economic activities or the real economy. There are many reasons. This is also from last year's report, and you find that if you put China into comparison with international or financial systems from the other countries, Chinese system stands out in two directions. Number one, the government still intervenes quite heavily compared to other countries in the financial system. Number two, the banks account for relatively high proportion of the overall financial system. That system looks a little bit strange because you look at this diagram, China is on the up right corner of the diagram. So to some extent, it's extreme. But you look at the last 40 years, I would say it probably was working well, supporting growth and maintaining financial stability. But you look at now, it looks like there is a growing gap in terms of the financial demand, which is not really satisfied by the financial sector. So for instance, SME funding is always a big problem. Number two, the households desperately want to find places to put their saving, but there's no really viable channels for investment. And there is a significant gap. Number three, even the government will probably need to find sources to raise stable sources to raise funds. But at the moment, a lot of local governments are relying on the so-called local government investment vehicles to raise a fund. These all mean the formal sector is probably not doing a satisfactory job in delivering the needed financial services. So financial innovation has been happening in China already. It's quite dynamic. And if you regard shadow banking and fintech as the ways of financial innovation, but you had a good innovation, you had a bad innovation in the fintech space, for instance. The mobile payment revolution is really a good one. I think it's inclusive, it's efficient, it helps everybody. But you also had something like the peer-to-peer lending platforms. It's also innovation, but it really is collapsing at the moment. It's not really making lots of positive contributions. So I think it's very important to distinguish good innovation and bad innovation. So what is the key to make sure you have a good innovation but not a bad innovation? I guess the key question is whether, number one, whether we're able to solve some of the problems in the real economy. So, for instance, the gaps in three areas. If financial innovation can fill in these gaps, then it probably is good. But this is only one criteria. The second criteria, I think, is equally important, is that you're able to control the risks you manage the risks. So peer-to-peer lending is one good example. Originally, people would say, well, these are very good innovation because they lend money to people and individuals or SMEs never would be able to borrow from the banks. So it sounds like also inclusive finance. But the problem is they have no effective ways of managing risks. In the end, it's not good finance. So that, I think, is very important for us to keep in mind. Now, the key challenge going forward is really how do we support the transition of the growth model from input-driven and now to innovation-driven. There is certainly a bigger gap between the need to support innovation and to maintain some financial logic, to maintain the financial logic. Economic innovation or innovative activities in general, they are long cycle, they are very with significant uncertainty and probably also high probability of failure. But most of the financial investment we see in China, certainly, they in short term, most of them, they have a low tolerance of risk and seek to have a very high return. So these are the two things you can't really match together using the Chinese financial system to support growth, a new economic innovation. The first thing about innovation we came up with was this idea about optimal financial structure. This was actually proposed by Professor Justin Lin, who did the first sub-report for the project. The optimal financial structure, I think that in essence, the idea is that we need financial services that can be suitable for the demand, financial demand at a different stage of development. So for instance, if you're developing labor-intensive manufacturing, your financial service should be ideal for supporting these activities. If innovation becomes more prominent, the financial services also need to evolve and support these activities. So I thought that was a great idea. The only thing I want to modify on Justin's thesis is that he believes that if you're at the low end of development, we need lots of small, medium financial institutions. When we move up the technological ladder, we need a lot of capital markets. I think in theory that's okay, but my own observation, my own experience tells me that the financial structure doesn't change quickly. Although economic structure can change relatively quickly, you look at around the world, the financial system in US or financial system in Japan, many other countries, they don't change like rapidly as income levels rise. And that to me means optimal financial structure is important, but perhaps we should focus more on the function of the financial services, not necessarily the format of financial institutions. So for instance, now we need to support economic innovation. Should China really rely on developing a large capital markets to support economic innovation? I think that is a good idea, but myself is a bit skeptical about whether or not China can have a huge capital markets in the perceivable future. But on the other hand, if you look at Germany and you look at Japan, you can also rely on indirect finance supporting economic innovation. Banks can also do the job. So my own sense is that maybe we should also focus not just on developing the multi-layer capital markets as the government trying to propose, but at the same time trying to change the way the traditional financial institutions operate so that we can support the economic innovation more effectively. The capital market is very important, as I said, in supporting economic innovation. But at the moment, it's relatively small in terms of share of total financing, about 10%. But even with that 10%, it's probably not doing a very good job in terms of supporting economic innovation. We have been developing the capital markets for almost 30 years, but I must say this is probably one area we have achieved little progress in terms of forming efficient and effective capital markets. So there are lots of jobs need to be done. I think we can evolve, and you look at the problems suggested by regulators and financial economists. There are lots of problems. Too much control by the government and the regulators, especially on the pricing, issuance of IPOs. And too many retail investors, not enough institutional investors, not enough opening. We have some opening, but it's mainly through channels, not comprehensive opening, and so on. So I do think we need to recondition the market system, the mechanism of the capital markets, if it really we wanted to support effectively financial system. But again, as I said, my own sense is that we need to make efforts to support the capital markets development. But we shouldn't really think that in a few years, the share of the capital markets will be as high as in places like the US and the UK. We probably should look more closely at the experience of Germany and Japan, how they use the traditional financial intermediation to support industrial upgrading. In that sense, the banks will probably still be very important, and they will continue to be the main financial service providers. There, obviously, we have a lot of things to improve, and one of the key problems why banks cannot effectively support innovation, and particularly SMEs, because they traditionally look at historical data, look at the fixed assets, look at government implicit guarantees when they make loan decisions, lending decisions. So when they face the SMEs, they really don't know what to do, how to assess the risks. In that sense, we need to make lots of changes. In the banks, the Chinese banks, we're also seeing a lot of new innovation. So for instance, there are some banks established the so-called tech branch. They're using a supply chain finance to support the SMEs. And they're also trying to combine the investment bank and the commercial bank operations, linking the banks with the capital markets and so on. There's also one big issue there is interest rate is not liberalized. And most of the banks could not really implement the so-called market-based risk pricing. And that is seriously constraining banks' ability in servicing the SMEs. Even now, the government is pushing them very hard to extend more loans. But if you cannot charge higher lending rates to the SMEs, you know what would happen. So this is an area I think we have to make lots of changes. Shadow banking, as I said earlier on, in my own view, is one form of financial innovation. In fact, what they did was they moved off the balance sheet, trying to support the SMEs and other economic activities. But so it's important when we look at the shadow banking in China. Number one, most of the Chinese shadow banking businesses are shadows of the banks, mainly because they're done by the banks. And number two, it's important to recognize two sides of the shadow bank. On the one hand, they bypass the regulation so that they create a lot of new risks. But at the same time, they move off the balance sheet. They also bypass the unnecessary state intervention in the financial system. So for instance, when you do off-balance sheet, you can charge relatively high interest rates. Therefore, you can serve the SMEs and some of the other companies. So when we're trying to deal with the shadow banking businesses, it's important to keep both sides in mind. When you crack them down, it's useful to keep them regulated, supervised. But if you cramp too harsh, then you're going to see significant collapse of the financing, and that's what we saw last couple of years. So we need to ensure the transition is, number one, relatively smooth. Number two, after the transition, some of these activities supporting the SMEs will be able to continue even when they become regulated. One of the biggest story of financial innovation in China is this so-called fintech. And one of the areas, as I said, the difficulties we're facing is the banks don't know how to deal with the SMEs because they don't have a lot of historical data, they don't have a lot of fixed assets, and normally they don't have government implicit guarantee. But the online lending, online banks are doing a fantastic job. The 3 banks I listed here, each of them now probably with between 1,000 to 2,000 staff because they're online banks, so they don't have branches across the country. But each bank now extends more than 10 million loans each year, SME loans and individual loans. This is massive. And this is why I think the fintech development in China is most important about financial inclusion, improving access by the individuals and SMEs to financial services. Mobile payment, I mentioned, is one very successful area, but online lending by online banks is another case of very success. We, in fact, did a paper with the PIIE economists just to show, in the Chinese case, the fintech credit scoring models actually performed better than the traditional credit scoring models. But obviously, this will need to be reassessed as the financial cycles evolve. But we have tentative findings showing that the fintech can actually do a good job without relying on historical data and the fixed assets. This is one of the interesting findings. Our institute at Peking University developed this so-called the Peking University Digital Financial Inclusion Index for China. We have numbers for each county, each prefecture, each province between 2011 and 2018. This is the mobile payment index, and the darker the color, the better the coverage. You will find that the left map is for 2011, and the right map is for 2018. Well, you can tell that within that 7-8 years, the coverage, the mobile payment coverage really extended to the rest of the region. You look at 2011, only a small area around the East Coast had the mobile payment services, but now it's everywhere. The line I draw is the so-called Hu Huanyong line in China. This was originally proposed by an economic geographer. He did a paper in 1935 and draw a line between Tengchong in Yunnan province and Heihe in Heilongjiang province, divide China into 2 parts. To the right of the line is about 46% of the land area, but supported 96% of the population, which really means economic activity is concentrated in the East Coastal area. And the government has been trying very hard for decades, trying to balance economic development. I think the government achieved something, but the same story still continues. What we find is you look at the digital finance, you look at the mobile payment, it's actually moving to the West much more dramatically. And we have an aggregate index also to show that the regional gaps narrowed significantly. And I think that's easier to understand. The reason is because for people like us who live in Beijing or Shanghai, this mobile fintech tool is one of the financial services that we can use. But when you move to the west part of the country, this is the only financial services for them. And this is why, for them, the marginal value is much higher. And I think this is a great revolution in terms of fintech. There's also a story about restarting the RMB internationalization. To save time, I'm not going to get into it, but just to say, the internationalization of RMB started in 2009. That was around the time when, we just came out, we're still in the middle of the global financial crisis, and there was kind of a demand for additional global currencies, and the Chinese authorities pushed. But this whole process came to a halt in 2015 following the so-called reform of the central parity of the exchange rate. The lesson I think we should learn from that process was it's useful to push ahead with internationalization of the currency, but you need to coordinate with all the other policies. In other words, some people used to say sequencing is very important. When the exchange rate is not flexible and you're pushing ahead so much with internationalization, in the end, it backfires. When exchange rate flexibility became a key constraint, we actually had to unwind and even reversal of some of the opening earlier. Now we're going to open up. The reason why we add this chapter here is we think internationalization of RMB is also an important part of financial innovation, and financial innovation is necessary for supporting economic activities. So then I will conclude. The story about economic development over the next 30 years will be a very different one. We'll not be able to rely on low-cost advantage. The population will age, and we probably can depend less on the external market. But I'm not saying we'll become inward-looking, and I think outward-looking will still be important. The key change is that if we rely more on quantitative expansion in the past, quality improvement would be a central story going forward. That is why innovation is most important. How to support innovation? The financial system will need to change, and I discussed about the capital markets, the banking sector. My own sense is between the two, I think we should focus more on the banking sector. But the capital market is important. We should try our best. But for a very long time, in my view, the banks will continue to account for something like way above half of the total finance. So how to make them effective, efficient, that is a very big part of the story. So we have suggestions in all these different areas. But the critical question is, number one, to start before we can talk about the financial innovation, what we really need is to provide the right policy environment or market environment. So for instance, are we going to really to enforce the market disciplines? Are we going to clean out all these zombie firms? If we cannot do that, it's very difficult to improve financial efficiency, let alone supporting economic innovation. So that is the broader set of the policies we require. I'm not going to get into the details of specific innovation, but the final point is we also need to put into place a new regulatory framework. That new regulatory framework should be new because now the financial innovation is moving into some of the new areas. So for instance, policy coordination becomes much more important. And also, for instance, the tech becomes an important part of the financial services. Regulation also needs to keep pace. You can't just rely on the financial institutions reporting every 6 months to watch the risk. You need a reg tax or SUP tax to monitor the risks. But most importantly, I think what we saw in the past few years is innovation was actually happening without necessarily the government starting the process. There is a real demand, there is a response in the financial sector. For the regulators, what is important is to find a balance, trying to balance between innovation and stability. Thank you.
Yiping, thank you very much for a very comprehensive presentation of a very complicated topic. Copies of the Jinshan report are outside. I commend it to all of you to pick up and take a look at it in more detail. To start our discussion, I want to introduce Nick Lardy, our Anthony M. Solomon Senior Fellow here at the Institute. Nick has been called everybody's guru on China. I think that's true, at least here in the United States. Nick's latest book was called The Market Strikes Back, the State Strikes Back. Nick wrote a book 5 years ago called The Markets Over Mao. in which he traced the evolution of economic liberalization and reform in China. But, as Yiping said, there's been some reversal in some parts of that. So last year, Nick published a new book called The State Strikes Back, in which he traces some of that reversal. And he's done a lot of work, particularly in the financial sector. He's going to start our discussion today with some comments on Yiping's remarks and the new Xinjiang report. Nick.
Thank you very much, Fred. I'm delighted to have a chance to comment on Yiping's report. I'm going to talk a bit about the financial sector, but I'm going to put it in a macro context and tie it in a little bit to some of the trade issues, so maybe it can serve as a transition to the second panel after we finish this panel. I want to talk first about the slowdown that China's been undergoing. I think Yiping was emphasizing longer-term structural changes, the demography and so forth, the changing nature of the global environment that will affect China's growth process over the next several decades. But I think as we're looking over the last decade, I think some cyclical factors have been very important in explaining a large part of the slowdown. And I'll just mention four. First, of course, is the trade surplus had in most years since the global financial crisis has been shrinking, so the external sector has been a bit of a drag on China's growth. We have the credit slowdown, been a very substantial slowdown in credit as China has addressed the accumulation of financial risks that followed the rapid growth of credit after the global financial crisis. This year, for example, broad credit growth is running at something under 11%. That compares with something close to 15% in the first 3 quarters of 2017. So since over the last couple of years, there's been a big slowdown in credit growth, which has, I think, had a dampening effect on economic growth. And not only has there been a slowdown, there's been a change in the composition, which we saw in one of Yiping's charts, and that is in particular the shrinkage of several components of non-bank financial finance or the shadow banking system. So the credit slowdown and changing composition of credit, I think, has been a factor. Thirdly, since the global financial crisis, really since around 2012, 2013, there's been and I'll show you this in a minute, a very strong shift in the nature of bank lending, and it's shifted very strongly in favor of state enterprises, and private sector, I believe, has been significantly squeezed out. And I think the slowdown in the private sector is one of the factors contributing to the slower growth in recent years. Now, finally, the fourth factor is trade friction. But I'm going to argue that slowing credit growth and credit misallocation are the major sources of the slowdown over the last decade, and I don't think the trade frictions to date have been significant factors. Just let me look at a couple of the factors. On trade, for example, it is true China's exports to the U.S. are way down, but China's global exports have held up very well because exports to the rest of the world have more than compensated for the slowdown in exports to the United States. In RMB terms, China's global exports are up 5.2% in the first half of the year. So import growth has been very weak. So we're now in an environment for the first time in quite a few years in which the trade sector is actually contributing to economic growth. In other words, the trade surplus is growing and it's contributing to a significant portion of China's growth. So at least so far, I would say, if you look at the trade side, and keep in mind, remember, all the international agencies are saying that global trade growth is 1% or less this year. China's done better than that, despite the trade frictions with the United States. A second factor to focus on is obviously foreign direct investment. I think some people have gotten the idea that there's a big exodus of foreign firms from China. They're reorganizing their supply chains, and everyone's gone to Vietnam or Cambodia or Bangladesh or somewhere else because of the tariffs that have been imposed in the U.S. market. But the data don't even remotely support this. China's inbound foreign direct investment in the first half of this year was $82 billion. second only to the United States. That's an increase of about 3% over the first half of 2018 before the tariff war started. And the OECD just put out a report last week that shows that globally FDI flows are down 20%. So global FDI flows are down dramatically, and China's FDI inbound is holding up quite well and actually continues to expand. It's still expanding at roughly the same pace as the 5 years before the trade frictions began. So my view is that trade and investment restrictions have not really contributed much to the slowdown. So I think the slowdown is more the slowdown of credit, and as I said here, in what I would call the misallocation of credit. Now, I think the Jingshan report has a lot of detail, and Yiping touched on it, a lot of very good positives. I think the repeated emphasis on the need to better serve micro and innovative enterprises is a very important feature that gets emphasized repeatedly. It acknowledges very explicitly that a lot of funds are flowing to state-owned firms that can't service their loans, and they get bailed out. And of course, this reinforces a tendency for banks to continue to lend to SOEs and not to private firms. The other thing, and he didn't mention it, but I think it's very important when you read the report, that it, at several points, emphasizes the importance of competitive neutrality. This is a theme that has come up repeatedly in China. Li Keqiang and others have mentioned it. It's a very important objective. It basically, I think, from my layman's point of view, competitive neutrality simply means that any action that the government takes should have a similar effect on firms regardless of their ownership. So it should have the same effect on private firms and state firms. So if you have competitive neutrality, you can't have a financial system that's lending most of the money to the state sector, for example. Now, on the other hand, the Jingshan report does not, I think, adequately address this issue of credit misallocation, and I just want to give you a few indicators that lead me to this view. First of all, according to the data published by the Minister of Finance, the return on assets of state companies, which has never been very high, has been declining continuously since the global financial crisis. We've gone from 3.5% to 2%. So the productivity, this is consistent, of course, with Yiping. I'm not saying it's the cause, but it's consistent with Yiping's diagram showing the decline in total factor productivity, or the weakening of total factor productivity since the global financial crisis. The losses of state companies have gone up. If you look at the second to the last column, you see that the reported losses of state-owned enterprises have roughly tripled since just before the global financial crisis, going from around 500 billion RMB to about 1.5 trillion. So whether you're looking at ROA or losses, and it's really quite shocking that roughly 40%, 2/5 of all state companies are losing money. It hasn't really changed very much, maybe a teeny bit less in the most recent year, but a very high share of state companies are reporting losing money. This means they cannot fully serve their financial obligations. They can't fully serve. If you're losing money, that means you haven't fully paid the interest on your outstanding loans, let alone repaid much of the principal. On the other hand, the share of lending going to state-owned companies has skyrocketed since roughly 2011, 2012. You can see that back in 2010, 11, 12, and 13, over roughly half the credit was going to private companies. Now, this is one of the, I think, issues that is not addressed. I mean, I think Yiping in the report focuses on the fact that it's difficult for banks to lend to private companies. They don't have enough information on them. They don't have enough assets. They don't have enough collateral. Maybe they're not making enough money. But despite those problems, the banking system was lending more than half its money to private companies in the early part of the current decade. And then after that, you can see the share going to state companies skyrocketed up to more than 4/5 by 2016. So I think that's one of the things that's not addressed. And the Jingshan report, I think, has a lot of conventional wisdom about how difficult it is to lend to smaller companies and to private companies, but that doesn't really address this ability of banks to do that. I happen to think that what has happened is the implicit guarantee of lending to state companies has been substantially enhanced in the last 5 or 6 or 7 years, and that has led banks to change the direction of their credit. That's the only explanation that I can think of that makes much sense. Now, unfortunately, these data are no longer being published. People's Bank, this data comes from a financial almanac published by the central bank, and the most recent version of the almanac should have had the 2017 data in it, but the data have disappeared, no longer published. So I've been trying to figure out another way to look at this question without these data. And fortunately, the Chinese government just released the data on the assets of state-owned companies. And the assets of state-owned companies, as you can see, back in the period when the lending to private companies was relatively high, state-owned assets were growing relatively modestly. Since around 10, 11, 12, around 12 or 13, it starts to go up. From 2012 up until the end of 2018, the assets of state-owned companies grew at 15% per year in nominal terms. That's twice the rate of growth of GDP in nominal terms. No, it's actually 2.3 times the rate of growth of nominal GDP. And the assets of non-financial state companies, so we're not counting the assets of banks and insurance companies and so forth, are 210 trillion RMB. That's the 2.3 times GDP. So even though we don't have the lending data, the very rapid growth of the assets of state-owned companies suggests that banks are continuing to lend a disproportionately large share of their loans to companies where productivity as measured by return on assets has declined fairly persistently over the last decade. So I would say, in terms of the reforms, I agree with Yiping's observation that there should be a very substantial emphasis on changes in the banking sector. Just layering on a more complicated capital market on top of an underperforming banking system is not likely to lead to an improvement in the allocation of resources. But I would agree with him. I think what really has to be done is there have to be hard budget constraints on underperforming firms, getting rid of the zombie firms, as he labels them. There has to be a big increase in merger and acquisition activity, so underperforming firms have to sell off their assets or be taken over by more productive firms. And you have to have a much more commercially oriented banking system. And I was resisted for a long, long time. As Fred mentioned, I've done a lot of work in the financial sector over the years. And I've resisted this simple idea that, China has to have a much bigger private banking sector. But I'm now to the view that really we should be beginning to think about having a much larger private banking sector to add competition. We've had a huge proliferation of new financial institutions. The share of the big four or the big five, or they're now talking about the big six because they're counting the Postal Savings Bank. The share of assets controlled by that universe of financial institutions has declined dramatically, but I don't think the performance of the financial system has improved. So maybe there needs to be a serious discussion about introduction of private banks to add more competition to the mix. Thank you.
You go in the middle. Okay, thanks to both Yiping and Nick. We've got about 20 minutes for discussion to round out this first part of the program. I would first ask Yiping if you want to respond to anything Nick said, particularly his last points about the shift in allocation of resources, and then we'll turn to the audience as a whole.
Okay. I will probably respond to 2 points quickly. Number one is Nick's explanation why the Chinese economy is slowing down. It's mainly because of misallocation of credit. I do think misallocation of credit is a big problem, but I'm not 100% sure that was the dominant reason why the economy is slowing down. I'll give you two reasons. Number one is, well, the economy is slowing, and if it's growing at around 6% at the moment, it's not so out of range compared to the fact that China is becoming more advanced. The growth rate is gradually coming down. So I'm not 100% sure that was the main factor. Second, when we think about misallocation, there definitely is an institutional factor behind. But you also think what happened the last 10 years was when the economy was slowing, and we had a big financial crisis in normal situation. Normal entrepreneurs would deleverage and slow their borrowing. So I think what happened in the private sector, except what happened the last couple of years as the result of deleveraging policy. Early on, the private enterprises were deleveraging. In my view, that's a very normal response when the environment becomes very uncertain, when the economy is slowing. That's what normal entrepreneurs do. The SOEs stayed relatively highly leveraged. That partly because of the institutional problem, partly because they were part of the so-called 4 trillion yuan stimulus policy and to support growth. So I think a misallocation of credit is important, but I'm not sure, even if we don't have that misallocation problem, the growth today would be substantially higher than around 6% also. That's my first comment. The second response to Nick's question, well, criticism of our report, I didn't mention enough about this unfair competition or the competitive neutrality. I agree. I think this is a very important point. That, in fact, was our first recommendation. We have 8 points. The first point, as I said, is you need to make sure you have a fair competition, enforcing the market discipline, and the market actually clears. That's our point. So I accept Nick's criticism just to say we did emphasize in the report, and that's our number. We think that's the starting point, even thinking about financial innovation. Without that, we don't really want to get too much into financial innovation or economic innovation. Thank you.
Okay, thanks very much. Floor is open. I'd ask you to identify yourself, say where you're from. You can either go to the standing mic in the middle, or we've got a traveling mic up here in the front. Go ahead to the standing mic, and we'll start with this young lady.
Hi, Denise Carpenter with the U.S. Department of Commerce. I cover development finance. I'm just curious, I just read recently about the announcement and focus on blockchain in the financial sector and others, and I just wonder what the plan is for China to incorporate blockchain into this financial innovation going forward.
Well, Nick, you want to try? I'm not really an expert on the blockchain technology. I think there is a general feeling that blockchain is a very useful technology. In the financial sector, it's most famously known in the bitcoins, and it might actually also, a part of it might also be used in the central bank digital currency. PBOC is trying to introduce, but only a small part of that story. In other areas, it's most commonly applied in areas of trading off some of the bills and financial assets, but it's not really common in use of the payment services. Some companies in China also actively using it in the so-called supply chain finance. You can try to track and monitor whatever production or supply process you use. So my own sense is it's a very useful technology, but I'm not 100% sure this is giving us a revolution without causing some of the problems. In fact, we probably have a little bit of bubble at the moment. So I don't know the exact answer to your question, where we're going to see more breakthroughs, but just to say, well, this is a useful technology, decentralized, anonymous. These are all very useful features. It's very difficult to change the information going forward. But I think we still wait to see viable and large scale application of that technology in the financial industry.
Nick, you want to add anything? Okay, the floor is open. More questions? Back in the back? Yep, you. No, you. Either. Then you next.
Hi, I'm Jean Whalen with the Washington Post. Kind of a simple question for Nick Lardy. Why are the banks lending so much more to the state enterprises if the state enterprises' losses are growing? Is it that the state is leaning on banks to lend so that state-owned enterprises can create jobs or invest in R&D, but not necessarily make money? Or what's the point of that? Or is there no point? Is it all just sort of a mess?
My answer is very straightforward. I think the huge increase in lending to banks coincides with the time Xi Jinping came to power in China. He seemingly endorsed the reforms from the third plenum, which said that the market should be the decisive force in the allocation of resources. But shortly after that, he started talking repeatedly about making state companies bigger. The emphasis has been on size, not on efficiency, not on productivity or return on assets or any measure of efficiency. And I think many of the institutions in China responded. SASIC, which controlled a couple hundred of the largest state conglomerates, began a program, or they actually accelerated a program of merging them together. So they went from roughly 200 companies to something less than 100 companies, but no change in the scope of activity that was undertaken. So reduced competition, I think increased opportunities for corruption, given the large size of the complexity of these organizations. Some of these companies have hundreds of subsidiaries, most of which are not listed. There's very little transparency, a lot of, what do they call it? Related party transactions, which usually means the money is evaporating quickly. So I think that's what happened, and I think until I hear a more plausible explanation, I think you're putting the finger on state pressure is the reason. And I would emphasize it's a goal of having bigger state companies that get listed in the Global Fortune 500, which, by the way, is listed based on sales or revenue. It's not based on efficiency. If you ranked companies on efficiency, all those dozens of Chinese companies would fall off the list completely. And it's not employment, because total employment by state-owned enterprises is less than 15% of the workforce. So it's way down from what it was 20 years ago. So the simple idea that they're trying to maintain employment, I don't think is accurate. Most of the growth of employment in the last 20 years has been generated in the private sector.
Just to
go ahead.
follow up, is there some point to it though? Like, are there cases where it has worked successfully in some sense, where companies have had some major R&D breakthrough? And Mr. Huang, you may want to dive into.
I actually want to offer a slightly different interpretation. I'm not denying ownership discrimination in this credit allocation story, but imagine, I did lots of surveys and talking to bankers in China. If you're a bank official staff trying to make a decision, lend a decision today, which company, state-owned company or private company, would you lend money to? Even if you don't care about the ownership policy, I think there is a good reason why you want to lend to SOEs, because I remember this is a time when the economy is taking a downturn, and SMEs, the average lifespan is 5 years, which means every year 20% of them disappear. And when the economy is taking a downturn, it's very difficult. Again, if you're a banker, you're facing the SMEs, you sometimes don't know how to assess their risks. That's why it's much more difficult. For the SOEs, I mean, most bank staffs told me they don't really use the so-called ownership discrimination per se. But ownership discrimination is important in this sense because if you lend money to a private enterprise, if it fails, the money disappears. If you lend money to an SOE, normally the government doesn't favor outright bankruptcy. Again, this is ownership discrimination. But because they don't disappear, normally the government favors merger and acquisition and asks some stronger companies to take over the weak companies. It means eventually the money will be repaid to the banks. So if you're a banker, bank official, sitting in your office and looking at the two companies, even if you just look at the issue from pure risk control perspective, you have a tendency of lending to SOEs under the current situation. That's my slightly different interpretation.
Well, I don't think it's really very different because, China was slowing down in 2011, 12, and 13, and half the credit was going to private companies. So the thing that's changed is that the implicit guarantee for lending to state companies, I think, has strengthened. And so the phenomenon that Yiping just mentioned has become more important. You don't worry about the creditworthiness of a state borrower because sooner or later your money will be repaid from a stronger state company or directly by the state. And I agree completely. If you lend money to a private company, it goes bankrupt, you're going to, the loan will have to be written off. But keep in mind, in the industrial sector, the return on assets of private companies on average is 3 times higher than state companies. So there ought to be lots of good lending opportunities in the private sector. And I just want to comment on the innovation thing. I think Yiping had a very interesting diagram that he showed us on patents, and my memory is the green at the bottom was the share of patents coming from private companies, and it's going steadily up, and I think the last data point was
70% by private enterprises, 5% by the SOEs.
Point made, huh? If I could just push this one step further and ask Yiping another question. One other explanation, Nick didn't say it in his remarks today, but in his latest book, he suggests that China's growth is 2 full percentage points lower than it would be otherwise as a result of this, what he calls misallocation of credit. Now, Yiping has said he doesn't think it's that important, but Nick suggests it could be very, very large. 6% growth instead of 8% growth. Big difference. One other explanation, it was implicit in her question, is that in addition to the financial factors that you've both mentioned, that this is a question of political control. That the party, President Xi Jinping, want to maximize continued political control over the economy at the expense of some economic growth, efficiency, and productivity. That's a tough question for you, but how much weight would you attribute to that component of the debate?
I think the policy preferences over SOEs was probably important. But I also think Nick's number to show that the proportion of the credit going to the private enterprises, it's significantly slowed down or collapse. I think it was somewhat exaggerated. Part of the reason was during those years, we also had a surge of the shadow banking transactions and the fintech development. Remember, most of these funding actually went to the private enterprises. So you could think, I don't have an aggregate number. If you put together the balance sheet number and off-balance sheet numbers, the decline might not actually be as significant as Nick suggested. The point you also mentioned at the very beginning, Nick's assessment that the Chinese growth might be 2 percentage points below the potential. I guess depending on what is your assessment of the current growth rate. I mean, the current growth official rate is around 6%. If you think that number is significantly overestimated, then there is a case. I mean, I agree, misallocation of credit leads to loss of growth for sure. The question is how much is, if we are looking at the 6%, is this a reasonable number? To me, that is a reasonable number. And also, I think it's important today for us to look at whether or not the growth is okay. You don't look at the GDP numbers per se. What is probably more important is to look at the labor market. Our growth rate has been coming down since 2010, but the labor market in general has been stable and robust. If that, I mean, every quarter when I say the growth is probably okay, and people would warn me that next quarter there will be a big spike in the unemployment number, and I think I'm fully aware the risk of next quarter the unemployment numbers would rise. But so far it looks like pretty stable. If that's been stable for a long time, the unemployment rate, then I think we probably shouldn't worry too much about the growth rate per se.
Okay.
The diagram I had on credit was mainly from banks, but it did include trust and entrusted loans. And I agree with Yiping, there's a lot of other credit out there, and we don't, at least I have not seen very good data on who's actually utilizing that credit. But I would make the point, I think the private sector got squeezed out of the banking system, and they did turn more to shadow banking, but borrowing costs in the shadow banking system are generally substantially higher. So this was another dimension of discrimination against private banks, which used to be able to access the banking system, then had to turn to some extent, at least, to compensate to the more expensive credit in the shadow banking sector. But now they have the double whammy that I mentioned, and that is the shadow banking assets are shrinking. So lending from shadow banking, or at least some of the most important components of it, are going down. So first they lost access to bank credit. They shifted somewhat to compensate to more expensive shadow banking credit, but now that is shrinking. Now, it's very, I think Yiping makes a very good point that maybe this is a natural deleveraging process by private firms who are seeing slower growth, so that, you know, when you look at the outcomes in terms of borrowing, you don't know whether it's a demand side thing or a supply side thing, and I'm tending to emphasize the supply side. I think banks have been squeezed out. And I think that's also supported by official policy statements. Remember, Xi Jinping, and I think it was in the fall of 17, he had to have a meeting with private entrepreneurs and told them how important they were and a critical component of the Chinese economy, and that they would be supported. And then you had Guo Shiqing and other bank regulators telling the banks they had to increase their lending to micro and small enterprises, and even set forth some targets about how they should do this. So I tend to look at this as more of the private sector borrowing less because they're losing access both to banking and to shadow banking. On the longer term thing, one of the reasons, I mean, Yiping mentioned, you know, you would expect China to grow slower now because they're more advanced. But remember, China in per capita terms is still at only 25% of the level of advanced industrial economies. And from that point, Japan, Korea, and Taiwan grew rapidly for a couple of decades, and they got to 55% of the advanced economy level in the case of South Korea and Taiwan, or maybe something closer to 70 or 75% in the case of Japan. So I still think there's a substantial potential for convergence in the Chinese economy that would be generated through somewhat more rapid growth.
Okay, question in the back.
Hello, Mark Monnier with the South China Morning Post. So I think Fred sort of veered the discussion a little bit in this direction, but I wanted to hone in a little bit more. Fortunately or unfortunately, I covered the macroeconomy for the Wall Street Journal in Beijing for about 4 years. And so this is a great analysis, and these are incredibly interesting points. But we've had very wise gray beards point out many of these points for a long, long time. And even though the reign of economics sort of likes to keep itself separate from politics, we know that can't be done, particularly in a place like China, but even now with Fed policy here in the US, you can't make a clean line there. What is it going to take? We've been hearing for quite a while that the debt is unsustainable, that at some point that will lead to serious need to make these decisions. At the same time, we also hear that China has tools that no other market economy has, its ability to muscle state-owned enterprises to spend, its ability to affect markets, the monetary and the fiscal policy that you say it's been depending on too much. What will it take? What's the tipping point? Thanks.
Well, I think the policymakers' assessment of the problem changing over time. I think to some extent they respond to the real challenges in the economy. The reason why in 2016, for instance, the government adopted deleveraging as a national macroeconomic policy priority was because everybody realized that the leverage ratio was so high in China, if you don't stop, there would be a big problem. The last point you mentioned about the Chinese government might have some ways of mitigating the high leverage ratio. To some extent, I'm actually sympathetic. There are lots of people, when they look at China as a high leverage ratio, especially in the corporate sector, and they worry about the so-called Minsky moment. I personally think a Minsky moment is not something that will likely happen in the near future in China, mainly because the heavy leverage is concentrated in number one, SOEs, number two, local governments, and both of them linked to the central government balance sheet. In a way, I think the greatest fear for me is not a collapse of the financial market and an imminent financial crisis in China, but a continuous decline of financial efficiency and economic efficiency. So the worst case scenario, in my view, is like Japan's last decade or 2 decades. You continue to the efficiency to continue to decline. So at one point, whatever amount of resources you input, the economy won't be able to respond. So I do think there are some special features there. But I agree with you. Sometimes our responses are a bit slow. They realize the problem, we needed to make change, but we always face lots of different constraints. Although there are also other extremes, for instance, the policy we implemented in 2016, again, the deleveraging policy and the policy to clean up the environment. Many people feel that they probably are a bit too harsh when you're trying to deleverage pushed by the government, and it squeezed on the private enterprises and had a macroeconomic impact. So my take of what you just described is kind of middle ground. I think in many cases, especially with the so-called competitive neutrality, I'm not sure if we're going to see real competitive neutrality in the near term, in the perceivable future. But they identify the problem and hopefully moving in the same direction. So certainly from that point of view, I think it's positive. And one final observation from my own experience, I mean, when we look at China's reform as an economist, I always feel desperate and frustrated because the government would always move less than I hope they would have done. And so every year, every point of time, I criticize the government for not making aggressive enough policy moves to liberalize the market. So this was my constant feeling about the reform and the policy. But I also now I'm older enough and realize at times when you look back last 5 years, 10 years, it's a significant step forward compared to what used to be the case. If that continues, then I remain optimistic.
With that as a good summary, including the frustrations of economists around the world that their governments don't move quickly enough to do what they suggest. I want to thank Yiping in particular, his CF40 team, and the group in general for this very thoughtful and helpful report. I commend it to all of you. Copies are outside. I will call this first panel to a conclusion, turn the microphone over to my colleague Jeffrey Schott, who's going to now chair the second panel on the current trade conflict. Yiping, CF40, thank you very much for this.
Thank you. Thank you, sir. Thank you. That's right. That's right. I was just trying to have some discussion.
In the interest of time, I encourage you to stop talking and quickly get your coffee and sit down because we have three panelists on the second session, and we'd like to maximize the time for their comments and your questions. So the second session is on the how to manage the boundary of U.S.-China trade disputes. But I don't know who set the title for this session, because at times over the past year and a half, the trade disputes seem to be unbounded. And maybe that's the challenge we have going forward. We're hopeful that at least the first phase of a reconciliation can be achieved in the coming weeks by the United States and China in this trade dispute that has gone on much longer than many expected. And so we have three panelists to discuss not what is in the current prospective package, but how this dispute affects our economies and going forward. And we have three panelists. I would ask all the panelists to come up to the podium, and we will talk from the podium. The first is Mr. He Jiangchang, the former executive director for China at the IMF. In 2001, he was appointed Director General of the International Department of the People's Bank of China, and 4 years later, a counselor to the People's Bank of China. Second, we will have our own Mary Lovely, a senior fellow at the Peterson Institute and a professor of economics at the Maxwell School at Syracuse University. During 2011 to 2015, she served as co-editor of the China Economic Review. And finally, we will have Gao Xiaowen, who is a member of the CF40 Academic Committee and currently serves as chief economist at Essence Securities, where he's been since 2007. Formerly, he was the chief economist at Everbright Securities Research Institution. What I would suggest is our panelists open with perhaps 10 to 12 minutes of comments, and then we will turn to the audience for questions and hopefully as informative a discussion as we heard in the first session. So I'll turn the panel over to Dr. He.
Morning. I have to press something. Okay. Good morning, everybody. And I first thank CF40 and Peterson Institute for organizing this event and for inviting me to share some of my naive thoughts on these very complicated subject. I think that the casualties of the trade conflict between the United States and China have been spreading significantly across the world. And one of the sources of this risk is, I think, arises from the uncertainties that have been caused by the conflict and the handling of the conflict. So my remarks would try to concentrate on what are the sources of the uncertainty. One finding is that the lack of clarity of the goals of strategic goals of the U.S. government that has launched the so-called trade war, and the inconsistency of the approaches associated with this inclarity. And then second part, how to manage those, and how China can have a constructive role in managing the uncertainties right now. So I think that now looking at the strategic goals, I think at this moment they have been very confusing. For instance, people suspect whether the strategic goal is to secure dominance or to secure excellence. There is a great difference between that. The former would dictate a confrontational approach, while the latter would be likely achieved through cooperative or cooperation. Working constructively together could lead to greater prosperity for the US and China, as well as the entire world. But by weakening each other, probably there are good chances of reducing the world to one of Lilliputians. And second suspicion is, or confusing, is the difference between securing a balanced trade or fair trade. Because, the outcome could be very, very different. Fair trade would not necessarily guarantee a balanced trade, and vice versa. So lack of clarity in this on this issue could also lead to further confrontation down the road. And the market would also worry that the issues, whatever you do, the issues would come back. And as some of the US actions so far do have some decoupling effects, so market perception as such could also lead to drop in cross-border investment flows. So these examples show that so far the signals have been very confusing. Such an approach has failed to yield rewards or intended rewards of the US government. So far, you look at the export figure, you see in the first 9 months, US export to China has been barely 70% of that of Japan and South Korea. And also, barely reaches the figure of Australia. And only about less than Vietnam and Malaysia combined. So given the, this capacity of US to supply the Chinese market and the demand from China, I think that then the administration has to give a second thought to the current approach and what else could be working, against the U.S. exporters. So as far as I'm aware, there is no intended or restrictions initiated by the discriminatory restrictions initiated by the Chinese government. So there must be something, wrong here, something else wrong. So the first step, probably, to the solution to this confusion is to reduce the uncertainties and to clarify the goals. What are the goals? This would raise the chances that its actions are consistent with its objectives, and also raise the chances of avoiding the risks of a spiral of retaliations. And the second step could be for the responding party, for China to state the doables and undoables, explicitly. And this could facilitate material compromise without some clarification of the goals from each side. I think a compromise would be very difficult. And China could also advance the reform agenda with or without a deal. And that's, I think, very important. While I fully understand the intention of thrusting China's reform agenda into the deal, but I think there are very significant risks of doing that. First, I think that it may be perceived as Chinese government yielding to U.S. pressure, and it would be very difficult for the Chinese authorities to market those reforms domestically in this, environment of rising nationalism. So that's one. And second, second risk is if these reform agenda are conditional on U.S. actions, then sometimes you are not sure whether the U.S. would, on the U.S. part, the actions will be timely or implemented. So I think that would also have a risk of retarding the progress of the Chinese reform. And I think that finally, it goes without saying that such autonomous reform actions can serve to effectiveness of reducing uncertainty, especially when matched with significant or material down payments from each side. The good news is that recently at the Shanghai Import Exhibition, President Xi reconfirmed the commitment to open further and accelerate domestic reforms. So I think that especially the emphasis on the further opening of the Chinese economy. And I think that's quite encouraging. And we should wait and see, what the concrete actions will be forthcoming. And then I think there is also rationale to manage the expectation of the implementation of the deal. Even if the commitment from the Chinese side is fully and timely implemented, there is still possibility that some of the U.S. objectives will not be met. For instance, if the U.S. expectation is to push China toward the more market forces, then I think that in the end, with the improving of the efficiency of the economy, there will be greater competition. And if China, President Trump's label of China as a currency manipulator, if the intention is to increase the flexibility or appreciation of the RMB, then I think you should be prepared for competition at the higher end of the value chain. So these, and also I think, as I mentioned just now, fairer trade will probably not guarantee balanced trade. So I am prepared for the result. What lower hanging fruit can be picked? I think one of them is to probably for the US administration to decide to reactivate its participation in the TPP. And probably I think it could invite China to participate. If it's not, targeted at China, why not invite China to participate? So this could be, I think, a lower-hanging fruit or a candidate to work on. Another candidate is probably to reignite the negotiation on the bilateral investment treaty. Although it fell short of signature during the last administration, but I think as I was talking with Bob Donner just now, I think we achieved a lot from the negotiations. Just one example, China's adoption of pre-entry national treatment and the negative list policy toward foreign investment only came in that background. So I think that's important to switch in the mentality toward foreign investment. And another thought is on how to treat different issues. I think different issues should be probably placed on different burners. If it's in the same burner, they complicate each other because U.S. constituencies or different parts of the administration, they have different concerns. For instance, the national security component would be, probably too cautious on some of the interactions between Chinese business and U.S. businesses. So I think that some of the actions would, from national security point of view, might cause increased tension and hostility. And it would probably work the other way around and counterproductive to the objective. It would, increase the case for the Chinese government to strengthen the national, the state hand in the market. So I think that they are mutually, reinforcing. A benign external environment is critical to the progress of Chinese economic reforms. I think looking back, without the easing of hostility across the Pacific, the reform and political will and popular support to Chinese reform in the last few decades would not have been unmanageable. So I think that right now, given this, the consequences of the trade conflict, reducing the hostility would be also critical at this moment going forward. I will stop here.
Thank you very much. I greatly appreciate your comments. And they reminded me of a panel very similar to this one that was held last year at the first Shanghai, the China International Import Expo. The conclusion of that trade panel was also that China should continue to pursue domestic economic reform because it's in the interest of Chinese economic growth. And it would help move in the direction of resolving policies. And I think that was one of the central
I forgot to mention that one risk of placing the domestic reforms into the deal would be that the risk of perception by the Chinese population as we do this for the U.S. because that's asked by the U.S., not for our own good. That's one risk too.
Thank you again. And now I turn the floor to Mary.
Thank you, Jeff, and thank you for those comments. I certainly agree that the U.S. objectives are confusing. In fact, some of you may be familiar with my colleague Chad Bound's timeline, which has been hit thousands of times. I always warn Chad that, in fact, at least 1,000 of those have been hit by me so that I can keep up with all the ins and outs of the rate changes and what's been postponed and what's been actually levied. So it is confusing. But on the U.S. side, there's a lot of confusion about both Chinese intent and Chinese action. What I've been asked to do this morning is to try to link our discussion about financial liberalization to the trade war. And we had a very interesting presentation this morning by Professor Huang and by my colleague Nick Lardy. And I think that it's important to try to take some of what was in those that presentation and think about how it is related to the current conflict. It may not be obvious that these two things, financial liberalization and what's happening on the trade conflict, are linked, except perhaps through the sort of the obvious channel, which is more market access for U.S. financial service providers. But I think there are also important structural regions for linkage, and let me try to describe some of the interactions that I see, and perhaps there'll be some discussion about them later on. The first is that evidence is mounting that Chinese private sector productivity growth has slowed dramatically since the global financial crisis. And in fact, the report we saw today provided more evidence of that TFP growth has not only slowed down, it's actually negative. Since the private sector productivity growth drove the dramatic income growth in China experienced after the turn of the century and even before, the slowdown is very bad news for China. As we saw, the labor force growth has stopped, the dependency ratio is increasing, and as Nick pointed out, capital is increasingly misallocated. So this slowdown in productivity growth at this time is, I think, really something that should have us all quite concerned about the future prospects for China over the longer term. Now, why the productivity slowdown? There's many possible reasons, some of which we heard earlier, including difficulty of private firms to access funding. Not only are there the evidence that was presented this morning and in the report, also in Nick's book, but there's also lots of evidence on the use of trade credit by private companies to provide working capital for their participation in global supply chains. So we have a long line of studies and access to reports that show us that private firms have been having difficulty to accessing funding. And this, of course, leads to a slowdown in the dynamism of the private sector, reduced entry and exit, which was very important in driving the productivity growth. So firms entering, goods firms being able to grow, and shifting sales from weaker firms to more productive firms is an important mechanism by which productivity within a sector grows. Now, there are other barriers to expansion besides lack of credit that include licensing, regulation, and other types of market barriers, all of which existed before the trade war. This idea of competitive neutrality is very important, not just for foreign firms vis-a-vis domestic state-owned firms, but also for private firms vis-a-vis the own domestic state firms. So these financial and market barriers that I'm talking about impacting domestic private firms and their productivity growth also impact foreign firms and are part of the reason for the current conflict, I think. Protection of markets for state-owned enterprises impacts private firms and foreign firms alike. The inability of private firms to achieve scale because of lack of regulatory or licensing to expand, or because of lack of capital to do so, boosts the incentive for private firms to engage in intellectual property violations. So I think we have to see these pressures that the private sector is under as also contributing to some of the pressures and unhappiness that we see in the foreign invested enterprises. I guess in short, opening through channels is not the same thing as broad opening. Opening through channels leads to directed access to capital. It leads to licensing and other barriers to really broad entry and of course, productivity growth. To conclude, I would just say it's important to note that removing barriers to market entry and allowing contestation of markets is very important for China itself to reap the benefits of its interactions with the external sector. Having private firms that are able to engage with foreign invested enterprises acting as their suppliers requires a vibrant and growing and allowing for failure as well as entry in the private sector. And without that kind of vibrancy and competition, China won't reap the benefits that it can by, as I said, an external, benign external environment. I think all of these are related to the financial liberalization discussion and suggestions that are made in the report, as well as to other issues in the regulatory environment. Thanks.
Thank you, Mary. It's seldom that we have speakers who actually don't use up and exceed their time, which is actually very useful because there's a lot on the table now that you've put on and others that we can discuss in the remaining time we have. But first, we have the pleasure of listening to Dr. Gao.
Thank you. Many thanks go to Peterson and CF40. It's my pleasure to discuss so important and difficult a topic of how to effectively manage Sino-US trade disputes. Let me start by telling a story. In January 2018, I have had the chance to visit DC with CF40 group, just when the trade war was being conceived here. Back then, people in DC had quite a lot of complaints about China. It was widely thought that a trade war was all but inevitable, and the sentiment against China was very negative. Based on this experience and information picked up here, I delivered several speeches in China in the middle of 2018, trying to summarize and present the logic of the ongoing conflicts in a timely and objective way, explaining the positions of the United States when necessary. Someone uploaded the audio speech online without my permission, and it was widely circulated and followed. People guesstimated later on that the speech might have reached more than 100 million people, some senior officials included. Most audience was just shocked by the message I conveyed and couldn't believe it. I was blamed to be too pessimistic and even unpatriotic. At the age of mobile internet and instant communication, when information is easily available, the reactions from those audience is confusing. However, what really worried me most in this story is that misunderstanding and mistrust between China and the United States run so deep and have been increasingly so in recent years. One scenario is that as China rapidly climbs up the value chain and grows bigger in its size of GDP, resulting in deeper mistrust and suspicion of each other, more disputes and conflicts then follow. Decoupling occurs and accelerates, and in turn, mistrust is further entrenched, creating a vicious circle. Eventually, we will be trapped in a fragmented world, which is less secure and less rich, to say the least. Against this background, it's very important to discuss how to better manage the trade disputes and Sino-US economic relationship in the future to prevent the scenario above mentioned from happening, or at least lessen its degree. Regarding this, history may provide helpful lessons. In 1949, the United States turned its back on the newly born People's Republic of China and fought a war with China in the Korea Peninsula and later in Vietnam, which was a big tragedy for both countries in hindsight. With great courage and wisdom of the leadership from both countries, President Nixon visited Beijing in early 1970s when China was still obsessed with the Cultural Revolution. And overnight, the world became safer and gradually more peaceful and prosperous. The key lesson here is that we can overcome the differences and disputes to build trust, pursue our common goal, and grow our common shared interests. Ever since then, the world has changed. The Soviet Union went into history, and China has evolved into the second largest economy and is still growing fast. However, the two countries still share widespread common interests, which shall be clearly identified and delicately preserved at this turbulent time. While the disputes in trade is well manageable, at least in principle. For example, climate change poses an increasing threat to the planet. Without cooperation and leadership from US and China, it's almost impossible to arrest the warming up trend, let alone fulfilling the commitment of the Paris Accord. As we know, free trade is the best way to enhance wealth creation, and a global rule-based system is the best regime to promote it. Without cooperation and leadership from US and China, the global rule-based system and free trade system may disintegrate. The list can go very long, and I just name a few. As for the trade disputes, though some claims and cases presented by the US are less convincing than others, overall speaking, they are solvable, and China is more than willing to do so. For instance, as the Chinese economy becomes more sophisticated, better IP protection serves China's interests as well. China's efforts and progress in this field shall be well recognized and fairly documented, as have been done by PIIE. Another example is forced technology transfer. Many Chinese scholars think the case is ill-defined and poorly presented, but China is still willing to compromise. The demand concerning bilateral trade deficits sound absurd to economic professionals, and the purchase list appears unrealistic, but China is still flexible on this issue. As mentioned above, given the importance and complexity of Sino-US relationship and the nature of the trade disputes, to better manage and strengthen the economic relationship, here are some suggestions. We shall emphasize that Sino-US economic cooperation is still an important ballast of the bilateral relationship, which is mutually beneficial and shall be carefully cherished and maintained. We shall stress that the trade disputes shall never ever be politicized and shall always be taken as a commercial negotiable matter. We shall take necessary measures to prevent the disputes from spilling over into other fields and impairing mutual trust and political sentiment further. We shall always support our claims and demands with convincing fact-based research, robust cost-benefit analysis, and feasible solutions. In order to let the message be delivered, we shall improve communication with each other and with the public. We could take a more pragmatic and incremental approach and start by solving the easy part first, as those issues concerning industrial policy and state interventions are very hard to conciliate soon. We shall take those essentially multilateral issues to multilateral platforms whereby concessions and enforcement could be easier to arrange. More importantly, this may contribute to WTO reform, as well as help sustain the globalization momentum in this critical time when it's challenged by rising populism. That's all. Thank you.
Well, thank you very much. A lot of interesting suggestions, some which will certainly not resonate with the Trump administration, talking about climate change, which is not a word that is used in the White House, but one where I'm sympathetic and actually gave a speech yesterday on the need for the U.S. and China to work together in the WTO on a trade and climate plan. But I think what we now have, because our speakers have been very succinct and with their comments, is we have extensive period of time, about a half an hour for discussion. It would be useful for the discussion to focus not only on what is desirable, but what is feasible and practical as we move forward in 2020, considering the political and economic conditions in China, and considering the political and economic situation in the United States, particularly with our presidential election. And we're likely to have a situation where the trade dispute will be enduring, or at least the tariffs that have been imposed, or many of the tariffs that have been imposed, will be enduring throughout this period of time, which will influence the considerations and the possibilities for adopting the cooperative approaches that have been recommended by the panel. So given that sort of overview, I'd open the floor to questions from the audience, and we'll start with you, sir. Please identify yourself and your affiliation.
Brett Fortnum with Inside U.S. Trade. Much has been made in the Chinese state-run media the past few days about China not accepting a Phase 1 deal without the U.S. agreeing to roll back at least some of the tariffs. This would be on top of punting on the scheduled December 15th tariffs. Is it possible, given much of the pressures the Chinese economy is facing, that China could accept a Phase 1 deal without that commitment to roll back tariffs? And if so, what is the economic value of a Phase 1 deal, given that many of the structural reforms, at least as far as we know now, don't appear to go much farther than what China has agreed to in previous fora, whether it's the SNED or JCCT or any long line of different meetings. And on excuse me, and on top of that, when talking about the liberalization of China's financial sector and the impact that could have on the trade talks, could it be that independent Chinese reforms to that financial sectors lessen some of the pressure that the U.S. administration feels to go after China by use of tariffs? Could it be that opening up the financial sector will cause the Trump administration to essentially take its foot off the gas a little bit?
I think there's something that all three of the panelists would like to respond to. So let's go in the order that we started. Dr. He.
Okay, that's a good question. But a question to that question is that, without rolling back some of the tariffs or reducing the uncertainty of not raising additional tariffs, then I would ask, what is the additional incentive of implementing this deal for on the Chinese part? Since the reforms are initiated domestically anyway, so probably that if greater the external pressure, probably the more reluctant on the Chinese part to move forward. So that was my original worry, as I was giving the introduction. So I think that probably there should be a kind of a switch or change to the narrative or the focus right now. Rather than, you do it for us, you have damaged our interest, but to focus on, on the domestic distortion, domestic fair competition, as Mary just now rightly said that some of the unfair treatment to the so-called to the U.S. businesses, probably it's not intended on the U.S. businesses. It's on the foreign investment in general. It's probably not equal treatment of the private sector vis-a-vis the SOEs. So I think that if on the domestic framework, if those disincentives are removed, then I think it will spill over to the foreign businesses. That would be easier persuasion. Thank you.
Yeah, obviously, I agree with that. I think this idea of competitive neutrality is very important and should extend to the foreign firms as well. That would help to ease some of the concerns of U.S. businesses operating there, who, of course, had a role to play in the Section 301 report. Regarding the desire of the Chinese to see some good faith effort to bring this to a close, which would be shown by postponing or permanently foregoing the upcoming tariff rounds or other tariffs. I think that we are going to see the U.S. postponing these tariffs, and I think for the following reason. It's not just that China needs an incentive, it's that the U.S. needs to stop slapping itself on the side of the head. I think that these two rounds were particularly damaging. I think politically and economically, they make no sense. The September round on clothing is likely to be very unpopular with voters once it kicks in. It does no good. Most of these are very small private companies that are working. You know, they're not really stealing the latest designs from U.S. designers. This is not the intellectual property that we're worried about. So it's a completely untargeted and costly instrument to use. On the December 15th tariffs, they're going to fall more than 55% will be just on laptops and cell phones, all of which are designed and marketed by U.S. companies. Samsung basically doesn't produce most of its phones in China for the U.S. market. So we're talking about U.S. phones, iPhones, laptops that are designed, marketed, and engineered by HP, Dell. Does it really make any sense to put tariffs on foreign-owned factories in China, like those owned by Foxconn, which are producing products designed and supporting employment in the U.S., to go after IP violation by who? This makes no sense, and I think would be very costly. It would have the effect of really boosting Samsung sales in the U.S. because they wouldn't be taxed versus our own domestic company, Apple. So I think that it's not just that we need to do this to give the Chinese an incentive. I think these make no sense for the United States.
I have no inside information regarding the trade negotiation. But my sense is that, first of all, the financial liberalization is overall helpful for the bilateral relationship, but it may have very limited, if anything, impacts on the ongoing trade negotiation. Secondly, as for the tariff and the slowdown of the economy, actually, I think the financial market of China has fully absorbed the trade war. And just as mentioned earlier by Mr. Lardy, China's export share in the world in the past year has not declined. Actually, it went up a little bit, suggesting that the shock to China's economy, overall speaking, is very limited at best. So it could not be the case that the slowdown forced China to concede quite soon, because its direct impacts on the economy is very limited, if anything. And the slowdown has many other reasons apart from the trade tensions. And I think China is more than willing to reach a deal to build trust, to sustain a more cooperative and friendly Sino-US relationship, overall speaking. That's more important for China to reach a phase 1 deal and ask for phase 2 and phase 3 if if there are in the future. That's all.
I would just add to that I don't think the Phase 1 deal is going to reduce U.S. pressure on China because in many respects, the actions taken have domestic political objectives in the United States, and those will only become more strident and more difficult to manage as we get deeper into the election cycle. Where any deal with China will be increasingly criticized by both the left wing and the right wing of the U.S. political spectrum for being insufficient. So while I think it is useful as much as possible to roll back the protectionism that has been imposed by both countries for our own interests, as Mary said, we have been applying the tariffs in a sledgehammer approach and not with a scalpel. And that has been meant for political effect and to send strong political signals at home and abroad. And I think that desire to send that political signal will remain in the coming months, certainly, and probably through the election. The next question.
Hi, I'm Anna Swanson, a reporter with the New York Times. You had talked about competitive neutrality. So I was thinking, I just wanted to ask, my understanding is that the implementing regulations for the new foreign investment law have been criticized for lacking provisions designed to address preferential treatment for SOEs. So is there any kind of practical vehicle for this actually to be done? And then my original question was, I wanted to hear your thoughts on decoupling. It's safe to say that decoupling is not a kind of simplistic binary that it's often described to be, but do you see decoupling as actually happening? And if so, along what dimensions and what are the effects? Thank you.
I'm not quite familiar with the specific of the current investment regulation vis-a-vis the how they are treated differently from the Chinese enterprises. I think, but I think that probably one constructive approach should be working on the framework of a negative list. So that's why I suggested that a negative list could be a kind of a platform to work on. See, you remove this, remove that, and try to shorten the list of because the foreign investment treaty, foreign investment regulation, still kind of why there is that one. It's you still treat. The assumption is that there is difference, but if you work on the negative list, it's not only to divide a line between Chinese companies and foreign companies. It's a negative list of, in general, what should be regulated and what should not be regulated. I think that would be probably a more sustainable approach. What's the next? The second question?
About decoupling.
Okay. Decoupling. I think decoupling itself, the magnitude of impact is not the key, but the psychological impact arising from the uncertainty. Because you see, if the market or investors perceive the US government intention as decoupling going forward, they would be reluctant to send their dollars, send their factories to China and vice versa. So I think that for long-term investors, this is a very, very dangerous phenomenon. Thank you.
Okay, so I think you've reported on this and other people on the foreign investment law, and I think this particular, I won't say flaw, but the lack of clarity on this issue about how foreign investors will be treated vis-a-vis state-owned enterprises, put your finger on a continuing source of mistrust between the two on this issue. And I think it shows it clearly shows the differences in how we see the world moving forward. So I think it's going to continue to be a source of conflict right there. So we know that foreign investors are subject to certain behaviors that they find objectionable, not simply on entry. So the negative list, as positive a development as it is, will not resolve these issues of how they're treated once they're in country and want to expand into certain business activities. So I think, especially when those business activities impinge on parts of the market that the state views as desirable for itself. So I think that this is really going to be a continuing source of conflict. When we look at the decoupling, it is not a binary, and we've been focused on decoupling in areas that really are not that important. It really doesn't matter if some of our shoes are produced in Vietnam versus China. Although this week the CEO of Columbia Sporting talked about how difficult it is to move even apparel operations out of China, given China's scale and skill at these tasks. So we're seeing far less decoupling even on these labor-intensive types of activities than we would have perhaps expected. But I think it's a much, much, much bigger issue when we look higher up on the value chain. A very large share of China's exports in high-tech goods come from foreign invested enterprises operating in China, which means that this cooperation between the external sector and the domestic economy is really vital for China to achieve its aspirations of higher quality growth. And I think this is really where a lot of the anxiety in China either does lie or should lie. Again, the psychological effect on investors. If we take decoupling to its logical conclusion and think of two, say, ecospheres for AI, it's going against everything we know about the current AI world, where research is done in both Asia and the United States, where ideas and talent are moving seamlessly across these worlds. To then bifurcate that is going to make, as Dr. He pointed out, it's going to make the world less prosperous. But you would think, which bubble, which side of this world is going to be bigger? And there's lots of reasons why you think the U.S. has a lot more at risk than we might sometimes say, especially when the president is strutting around about decoupling. But if you're China, you have to look and say a lot of the world is going to be on the other side of this barrier. And that's a scary prospect, I think, for looking ahead for their desire to move into areas that, like advanced manufacturing, that require a completely integrated world, which are going to necessitate those types of links to suppliers linked through 5G. So this lack of trust is really fundamental to the development of the commercial relations in these areas. And I think this is really what's at stake in this, not who or where our clothes are made.
So with your permission, let me add one comment on the question of decoupling. I think that I'm not quite familiar with the U.S. companies' reaction or perception on that. But as far as I know, the Chinese companies, potential investors into U.S., that's a very, very real concern. They sometimes very much want to participate. And I think Mr. Tu is here, and he was head of the China's Investment Corporation. I think there's many large projects, and some of them may be high tech, some of them may be critical infrastructure projects, Chinese companies are very reluctant to even initiate negotiations. So, because of the fear of, the review under so-called CFIUS. So I used to be a director of one of the investment companies, that was a real fear. The concern very frequently was raised there. So I think that probably even from the national security perspective, the best and most sustainable safeguard to national security should be or will be to have material stake in each other's territory. You have your stake there, you have the incentive to protect it. That's what I told my boss when we worked on capital convertibility, IMB convertibility, capital account liberalization. When we list the benefits, I said this should be one of the priorities in one of the benefit list, to open Chinese capital market, to open Chinese economy to the potential enemies even, so that you have a potential, you have interest in each other.
I am not an expert on law, but my comment on the foreign investment law is that the lack of details and clarification of the law is not an accident. The lack of details and clarification of the foreign investment law is not by accident, but by design, because it leaves flexibility and rooms to the executive branches to draft and change and update regulation in accordance with the law. And if the law, the details is made very, very clear in the law, then the executive branch will lose the flexibility to change, to adapt it to the changing reality. So I think it's the characteristic of many Chinese law, not just foreign investment law. So, and more importantly, as for the structural reform, which was raised many times this morning, an important comment is that if we look deep into Chinese history in the past 40 years, or even past 70 years, we can see that, particularly in the past 40 years, that the pendulum swings between left and right. It always swings between left and right. It swings to the right because only the right can promote economic growth, which is among the priorities for the party. And it swings back because it serves some fundamental interests of the party and social stability and the poor people and so on. So the pendulum always swings backward and forward because of some competing interests and competing aims pursued by the party and by the government. However, it's important to stress that only market-oriented reform can promote growth, which serves one of the fundamental aims of the party. And the change in the past several years, as far as economic growth is concerned, is self-defeating. And I think we can observe that since the end of last year, the pendulum is actually swinging back. And we shall pay close attention to the new trend, not just financial liberalization, but SOE reform and so on. My first comment. And as for the decoupling, I think it's quite complicated. However, at least in two areas, I think the decoupling is happening. One is supply chain, and the other is strategic high-tech sector. Thanks.
Thank you. I think the question was very useful because it made our panelists refocus on the investment and high-tech side of the story. And that is an area where U.S. laws that were promulgated last year are now leading to new regulations being developed by the executive branch that wants a great deal of flexibility. And that executive branch flexibility is moving towards creating greater uncertainty on the scope of restriction, both with regard to screening of investment coming into the United States, and we've seen foreign direct investment from China virtually dry up, in part because of this, and in part because of the greater uncertainty of the economic relationship. But it also affects regulations being developed for the Export Control Reform Act with regard to the export of high-tech products and technologies, not only just to China, but to other countries that do business with China. And so the scope of that regulation is yet to be clarified. Our colleague Martin Czempa is doing a lot of work on that. So you need to follow his writings on the Institute website. But it is an important component of U.S.-China friction, not just the tariffs. So I think we have time for another question, please.
Hi, thank you. I'm Zhang Xu with China's Taixing Media. And I also wanted to focus further on the decoupling on the technology side. About Chinese tech companies, we've seen not just the Huawei, but other high-tech or facial recognition companies being sanctioned. And also TikTok is reportedly on the CFIUS review. I'm just wondering, it doesn't seem like also some senators are really vocal on this regard, and it seems like there is really not anything those companies can do to ease their concerns. So I'm just wondering, what would you say these Chinese tech companies, are they gradually going to be impossible for them to do business in the U.S. and potentially in other parts of the world? And also for U.S. company operating in China, we've seen like Apple is being blamed for making some concessions to be able to in Chinese market. So how do you see those two things going? One Chinese company is operating in the U.S. and the other U.S. company is operating in China. Thanks.
My view is quite clear already. But one additional comment on that is that this, I think, increasing use of discretion or using the room of uncertainty is very, very dangerous. And I think it's based on the assumption is that U.S. technology is more advanced than China. It's going to be the case going forward. And the second assumption is that the U.S. can do better without cooperation in the technological field with China. So I think you have to think about that. Working together, it's I think the two-way flow of technology. So it's the assumption of if we work together too closely, you are going to steal our technology. From the Chinese side, there is also that kind of concern. And that kind of concern will be greater going forward, that if we work together, you will also steal ours. So I think that both sides work together closely. They add to each other's knowledge and also the potential to upgrade their own IT or AT, all those AI there. So I think that if you try to decouple, for instance, one example is that to scare away Chinese staff in the labs, in the US labs, you lose a lot. Thank you.
Yeah, this is a difficult territory, I think, for us, for both societies. I think it's becoming less about how much will hurt economically, where the costs are acknowledged but almost beside the point, because once the national security card is played, you're not doing an economic cost benefit anymore. There's another dimension to it, which is that these issues are becoming highly politicized, and they then turn on things like human rights and free speech. And again, those are sort of values which are very hard to subject to a cost-benefit analysis. And I think we've seen it cuts both ways. U.S. firms operating in China have learned to toe the line, or they'll face serious commercial damage. We've seen it with the NBA. We've seen it with Marriott, other companies. So this is a problem. It's a problem that Americans see as violating, their beliefs. So I was doing some media work on this, and both, media on the right, media on the left are up on a soapbox. Everybody seems to be upset about this. For Chinese companies operating here, obviously there's huge issues having to do with how they meet requirements for say, censorship within their own economy. So we have that how firms are operating in the other's economy become important for their domestic markets. It's a kind of interaction, intertwining that has some very serious hurdles and risks for companies doing business, I think, going both ways, and no easy answers.
Well, I think we're nearing the end of our time for this session. What I think we have concluded here on this panel is that there still is too much mistrust, and we need to start taking steps to restore a working cooperative relationship. That's not so easy to do in the political environment. But it is important, and it is important to maintain communications not only between governments, but between our peoples. And so the visa issue that Dr. He mentioned at the end of his last comment, I think is particularly important. It affects not only laboratories, but it affects research institutes, including the Peterson Institute. But it's critical that we maintain an understanding of each other, and that's best done when our peoples work together. So that's about the most optimistic thing I've said so far this morning, and so I should stop while I'm ahead, except to thank our three panelists for their comments and insightful answers to questions. Thank you very much. And Fred, for the last thank you.
Well, just to say, once again, to our colleagues from the CF40 for coming. It's been a great pleasure to host you again, to interact and continue this exchange of views on these very important and very difficult topics. We thank you for your contributions to the debate. I thank my colleagues here in the U.S. for participating in today's panel. Thanks to all of you for coming. Session adjourned.